So like an option that's deep in the money tends to have a superbly high delta that allows you to do what is called a stock replication strategy, which means that you can actually buy the option instead of buying the actual stock and spend less money, and it can actually allow you to get the same feel as if you're actually an owner in the stock. So let me show you an example, and then maybe I can pull in that example of getting out of a trade while we do that. And really, when you talk about getting out of a trade or rolling, I'll explain what you're actually doing so that it'll make sense when you actually step in and do it. Okay, so here, let's look at Apple. Okay, so with Apple, if I have a stock, let me see if I can find deltas on these things. Okay, so here, let's look at a call option. So here's a call. The current stock price is 229. Let's say I want to buy a call option, and let's say my expiration date, let's give myself a couple months, November 21st. And here, if you see the strike price, let's say my strike is 230, and that option has a price of $11 per share. Now, with that particular option, the delta, I'm going to look it up on Robinhood because it'll probably be easier. Because if I click on a page here, I might lose my page. So this option's delta is, I can find this exact option. So let me see. The date is November 21st. And the strike price, I'm buying the call, and the strike price is 230. Here we go. So that options delta is 0.55, 0.55. Write that down, 0.55. What does that mean? Well, that means that this asset is set up such that if the stock moves by $1, this options price is going to move by 55 cents. And it's a positive number, which means it goes in the same, it goes up. When the stock goes up, goes down, the stock goes down. If the number becomes negative, for puts, the numbers become negative because puts move in the opposite direction of the stock. But now, since we're talking about the call, this delta is 0.55, which means that if I want to get a piece of Apple and I want to be an investor in Apple, then maybe I just buy an option. The price of the stock is 229 a share. Let's say I want to get 1,000. I want to get access to controlling 1,000 shares of Apple. If I buy the stock directly, it's going to cost me $229,000 to do that. But let's say I want to do this with options. So I want to buy 10 contracts. Each contract is 100 shares, and I hit the market price. It's going to cost me $11,000. That's pretty good compared to 229,000. So I get in on the game with Apple for 11,000, whereas if I got in as a complete owner, I would have to put up 229,000, which would take a lot of my capital. So maybe theoretically, instead of buying 1,000 shares of Apple, maybe I find 10 different stocks and I buy at the money call options on those 10 different stocks. That's still riskier though. That's risky because if Apple doesn't do what I needed to do when I needed to do it by November 21st, I can lose every single penny of this investment. If this asset drops, if this price drops to 210, I lose the whole 11,000. Is that bad or is it good? I don't know. You tell me. I just mentioned to you that if I own the stock, if the price drops, I still own my stock. I lose money. My value drops, but I still own the stock. But if I buy the option, I can lose everything. Is that bad or good? What do you think? Okay, Danielle says not great. Dwayne says it is a lesson. Dr. Royale says it's bad. Terrence says terrible. Yeah, okay. Great answers. And I have to tell you that that's not the right answer. The right answer is I'm gonna give you a heads up. Almost every answer to every financial question is gonna be it depends. It depends. It depends on what kind of investor you are. Let me explain it like this. Let me pull up a let me pull up a page so we can take a look at it. Let me see. Can I get this freaking whiteboard? Here we go. All right, let's pull up a new whiteboard so I can show you. Okay. So let's say that you want to buy Apple stock for 229. Okay.